Nigeria's Finance Minister Zainab Ahmed has said that Nigeria is expected to exit recession in early 2021. She said that if, of course, the 2.3 trillion naira economic sustainability plan stimulus is approved by the federal government and strictly implemented. National Bureau of Statistics has forecasted that the economy could contract by as much as 4.2% in 2020. But the Finance Minister says deployment of the plan will improve the situation to a contraction of just 0.59%. Pretty optimistic. Central Bank of Nigeria Governor Emefiele has also forecasted a 1.3% contraction in GDP for 2020, even though many economists say a deeper recession is likely. Joining me to react to this as well as look at their outlook for 2020 is the head of research at Cardinal Stone, Philip Anegbe. Philip, good morning to you. So I want to start off with regards to the finance minister's outlook, where she says that the projection of the 4.2% contraction from the CBN could be moderated if the economic sustainability plan stimulus of 2.3 trillion is, implemented quickly. What's your take? We're going to look at excerpts from your report because you also have an outlook as to how GDP is going to, how the projections for GDP and then how that reacts or rather is impacted by the stimulus. How do you think it will play out?
I would think the comments are optimistic, very optimistic. However, two things that are worthy of note is the phrase quick execution. So if there's a quick execution, you may find that the recovery of Nigeria may be faster than was previously expected. However, our base case is for a GDP contraction of 2.4%. And that is because we consider the proposed stimulus, both from the monetary and fiscal side, to be largely inadequate. We are saying this stimulus could be just about 3% of GDP compared to 5% for sub-Saharan African countries. So we are thinking that the expectations from the finance ministers are very optimistic. But then a quick implementation of this stimulus could actually hasten the recovery process, maybe sometime early in 2021.
Okay. Thank you for that. You've got three scenarios from your report. So if you can give us a quick summary or a quick read-through of the three scenarios that you have with how the economy could turn based on how fast the government is able to implement its stimulus.
Well, we have three scenarios considered in our outlook report. The first scenario is the best case scenario, where we are saying that the economy may contract by only slightly, say a 0.5% contraction. But that is premised on achieving oil prices of about $50 per barrel. That is also premised on the expectations that the COVID-19 situation will not overrun our healthcare infrastructure. And it's also premised on not having like a significant first and second order effect of the coronavirus case. So if it's not that significant, if it doesn't go out of control, you may find out that the contraction may just be about 0.5%, and maybe the currency will still play around 390 naira to the dollar. Our base case expectation, which for us is the most likely outcome, is for the economy to contract by about 2.4%. And that is saying that we expect oil prices to average about $35 per barrel. We expect the coronavirus cases, confirmed cases, to continue to increase. We've seen that in the last couple of months. We are saying that that is likely to subsist for the current year. And we're also saying that there will still be some second order and first order effect of the current pandemic. And you only see gradual reopening of the economy. We know that a number of institutions are still not fully opened. Cinemas, informal sector businesses are still not fully open. Markets only, so many marketers only go to markets on select days and stuff like that. So you may see that contraction of 2.4% in our base case. The bearish case or the worst case scenario is for a 5% GDP contraction. And that will happen if you see an exponential rise in confirmed coronavirus cases. You may find that existing healthcare infrastructure may be overrun by the crisis. You may also find that there may be a reinstitution of certain restrictions across the country. if that case pans out. But then it's the worst case scenario, and oil prices could trend around the $25 level under that scenario. But like I said, base case is for a 2.4% GDP contraction under the base case assumptions.
Thank you for that. All right, let's talk about foreign exchange now. Let's see how your report sees things play now. We've got an image where you've broken down the foreign exchange components between swaps, FPIs, foreign portfolio investors, and then a number of other things there. And then you've got a net FX reserve if you back those out. But please give us your playouts or your strategy play for how you see FX playing out in 2020.
Yeah, we're thinking that you may see a 5% repricing of currency by the end of the year to around $400 levels. And we've seen the CBN actually harmonize rates across a number of FX windows, bar the parallel market. Like we always tell you that the parallel market is not important, that most of the transactions are actually happening in the I&E window and, of course, other windows. So we expect just a 5% repricing of the currency. And that's only a small restriction is premised on the reality that we've seen some oil price correction. Oil prices are now around $40 per barrel level, as opposed to the about $20 we were seeing when the crisis was still when the crisis was still very strong. And then you see that the CBN has already moved to actually do some repricing. So all of that plus the foreign borrowings that we've already seen, $3.4 billion. There's a further $2 billion that is expected from World Bank and AFDB and some other multilateral organizations. Those will actually restrict scope for currency repricing to about 5% in our view. However, we still think that the fair value estimate of the Naira should be around 445 Naira to the dollar, but we are likely to see a full repricing to the fair value estimate by year end in our view.
Philip, excellent stuff. We've only got about a minute left. I want to jump to your portfolio where you talk about how to invest in a low yield environment. You've got a portfolio here. Can you quickly take us to in a minute of how you put it together, how you expect the returns to play out?
Well, in terms of arriving at our portfolio, it's important to note that investment decisions are still tied to the risk appetite and overall profile of every investor. So you have to check those criteria to see whether they will be in a good position to take advantage of certain asset classes. However, in our equities portfolio, we've actually isolated.
Okay. Philip, I'm sorry. Unfortunately, we see the portfolio. I'm going to bring you back to talk about this more. We've only got about 20 seconds left. Philip Anegbe, Head of Research at Cardinal Stone, thank you for taking us through the outlook for the year according to your report. We appreciate your time.